Our strategy has largely stayed the same in theory over time. However, our strategy has evolved, and it's evolved as we've become more diligent about some of the details. And unfortunately, these are changes that happen with mistakes. It's very often, at least in the stock market, that the lessons you learn by losing money. So there were companies that I found very intriguing and very exciting and that we made investments in. And it was only after the fact, when we'd lost money, that you realize there's some nuance to that investment you didn't understand. It's understanding where your circle of competence begins and where it ends. And I'll give you a few examples. So back in the mid-2000s, Chesapeake Energy was a fascinating business run by a very dynamic and charming CEO. But it was understanding the leverage involved in natural gas. It was understanding how they acquired their assets. It was understanding that in a company that was incredibly profitable when natural gas was at 14 was effectively bankrupt when natural gas was at 3. It was a good lesson for me in leverage. I've had similar experiences in other industries where you learn about the true risk in something when you've had it go the wrong way. So in financial services, we own financial stocks. We're extremely conservative in how we pick them. You know, if you look back at an AIG or a Citigroup, what got them in trouble was the notional value of their derivatives. It wasn't the stuff that was easy to measure. It might have been off balance sheet. If you look back at a Lehman Brothers, it was the leverage. So at one point in time, Lehman Brothers looked like it was trading at book value, but it had 20-to-1 leverage. Now, what 20-to-1 leverage really means in the financial world is that you have $20 of assets and $19 of liabilities. Now, the problem is your assets move up and down. The liabilities stay the same. So when Lehman Brothers had a 10% drop in their asset value, they went from having equity to not having any at all. That is where leverage gets you in trouble. So we're very cognizant of that risk in the financial services sector, which is why we tend to own things that don't have that kind of balance sheet risk.